So today it's a great pleasure for me to introduce today's speaker in this session, Nate Kauffman from the Federal Reserve Bank of Kansas City. He doesn't have this listed in his bio, but he got his PhD in agricultural economics from Iowa State University, like our first speaker this morning, Seung-Ki Lee. But right now, Nate is he's the bank's lead economist and representative in the state of Nebraska, and he's the Kansas City Fed's principal expert in agricultural economics. So he talks about the agricultural economy through the 7 states of the 10th Federal Reserve District, but more importantly, the broader Federal Reserve System. And he's responsible for briefing the Kansas City Fed president, who of course sits on the Federal Open Market Committee. So Nate obviously has a connection with monetary policy as it's being undertaken by the Federal Reserve. And I'm sure many of you may have questions about, he may not be able to answer them, but he can certainly talk about the way he thinks maybe the Fed is going to think about inflation in the next 6 to 12 months. So without further ado, I'm going to introduce Nate, and he's going to talk about ag finance recovery. So Nate, the floor is yours.
Well, great. Thanks, Ian. And thanks for the invitation to join this morning. Of course, it probably goes without saying, would be great to see all of you in person and be able to be together, but I'll also appreciate the opportunity to join this way virtually. As Ian mentioned, I am with the Kansas City Fed, and I'm not going to belabor too much the point of what we do on behalf of the Kansas City Fed or the Federal Reserve System, as most people are probably familiar, but I will say just for a minute, for people who may not be familiar with the work of the Kansas City Fed and how that ties into this morning's discussion. So I think that most of you are probably aware, as Ian mentioned in the introduction, that the Kansas City Fed is one of 12 regional reserve banks that, together with the Board of Governors in Washington, comprise the Federal Reserve System. As was mentioned in the intro, we cover 7 states in the middle of the country at the Kansas City Fed. It probably goes without saying that a large portion of that region has a concentration in agriculture. So we've got a lot of lending institutions that are also exposed financially to ag. It's an area that we've focused on for a long time at the Kansas City Fed, and it's one that I'm responsible for leading. Because of the focus that we have in ag, and because within the Federal Reserve System, there are not as many that are focused exclusively on agriculture, we do also provide input then, as Ian mentioned, for the Federal Reserve more broadly when questions on ag come up. So just by way of introduction as to why some of these topics we'd be thinking about at the Kansas City Fed. I've titled the presentation this morning, an Ag Finance Recovery, and part of my reason for that is because it gives me the ability to say something different than I've been saying for about the past 7 or 8 years when it comes to agriculture. But I think is also worth calling this out because some of what's happened over the course of the past year really has been pretty phenomenal when it comes to where ag had been in the months prior. So I hope to be able to describe that a little bit. I do want to get started though. I'll talk more broadly about general economic conditions because a large part of that really is contributing to what we've been seeing with respect to agriculture. In many ways, ag and some of the pressures that it's facing are not different than what we would see in other sectors of the economy, and inflationary pressures being one of those. So I'll spend some time talking about that. Okay, so I'm going to advance forward here and just give a few quick thoughts of some themes that I think will come out during the course of the discussion this morning. I would argue that gains in economic activity, and this important to note, both globally and in the US, have supported a notable recovery in agriculture. And again, going back to what we might have been experiencing prior to the pandemic, or even the first couple months of the pandemic, is in sharp contrast. At the same time, ag finance conditions have improved dramatically, and I'll show some information on that. And as I mentioned here just a minute ago, there are still a number of risks, including significant cost pressures, supply chain disruptions being part of that, and I'll talk a little bit about some of those. Okay, so just to get started a little bit, and I'll try to work from something relatively general to something more specific as it relates to agriculture, and then even more specific as it relates to ag finance. The first point that I'd like to illustrate is just general economic activity in the US. And I'm showing the chart on the left-hand side, US real GDP. This is just a headline measure that we often show as a way to get started from a general perspective. going back to 1980. A couple of points that I want to highlight on this left-hand chart. The first is that the gray shaded regions, as most of you probably know, are recessions. And it's worth noting that the most recent recession here with the pandemic was the shortest recession on record. It technically started the end of February and ended, I believe, either at the end of April or early May. And you can see by comparing with the recent recessions that it was quite short. There was a lot of discussion at in the height of the pandemic, the first couple of months, of what sort of shape we might see for the recovery. Would it be a V shape? Would it be W, K? All kinds of letters that were being thrown out as to what kind of economic recovery we might see with the severity of the recession. The chart that you see here on the left-hand side very much does look like a V, but I think that it's important to caveat that with this is a measure of GDP. If we're looking at other measures, this would show something different. But the point here is simply to say that there was a sharp contraction in economic activity, then followed by a sharp bounce back. And we're not quite to the point where we might have been had the trend continued from before the pandemic, but you can see that it has been a pretty sharp bounce back nonetheless. The chart on the right-hand side then simply shows an unemployment rate, and I've shown here Nebraska specifically just because I'm located in Omaha. It is a large ag concentrated region to give a sense for something that you might see different than the US. And similar to broader economic activity, we saw a spike in unemployment rates at 14.7% nationally. And that too has dropped back considerably, not quite to the point nationally where we had been prior to the pandemic, but nearing that mark. You can see in the case of a state like Nebraska, where there had not been as significant of a rise in unemployment, we're actually quite a bit below in terms of unemployment where we had been prior to the pandemic. Okay, so moving on beyond a US discussion and trying to broaden this to be a bit more global. The point that I'd like to make on this next slide is simply that economic growth, kind of continuing the theme of the strong recovery and bounce back, is expected to be quite strong in 2021 and probably again in 2022, but at a slightly slower pace. So I'm showing a number of different regions or major economies here to give a little bit of a benchmark. Many of you will recall the months or the years from 2015 to 2019, when the US economy had been growing on average somewhere between 2 to 2.5%. It was relatively steady, but yet relatively modest at the same time. It was the longest economic expansion on record that we experienced coming out of the previous recession and financial crisis, but again, only growing at about 2 to 2.5%. The green bars that you see there do show the sharp contraction last year, but it's worth pointing out that those numbers ended up being a lot better than what might have been expected or feared in April of 2020 when the economy was generally shut down both in the US and elsewhere. Going forward to 2021, you can see that we're expected to grow in the US at around 6%, which of course is much higher than the years prior to the pandemic, but probably not also not sustainable. So there's an expectation that as the reopening sort of completes and we see the pandemic at some point start to fade, that those numbers would start to come back to something that would be closer to long-term sustainable. It's not just the US though, this is a similar phenomenon that we're seeing in other places with the bounce back from last year's recession and sharp contraction. Just as a way to say that what we're experiencing in the US is in many ways not unique because this is a global pandemic. We're seeing something similar play out elsewhere. So we've seen a lot of jobs return, as I mentioned. The unemployment rate has edged down considerably, both in the nation and in most states, for that matter. But we do still have employment at a level that would be less than where we were prior to the pandemic by about 4 million jobs. So the chart on the left is just showing the level of employment for the United States. And again, you can see that we lost during the worst of the pandemic about 25 million jobs. So very, very quick, very sharp. And then many of those jobs started to be returned and then at a slower pace here the last couple of months. So still about 4 million jobs less than we had been. The chart on the right then shows that there's been quite a bit of variation though as to which industries have been hardest hit. And again, as I work through the presentation, my goal is to kind of set the stage at a general level before digging in more specifically to ag. The chart on the right would show that most of the weakness was concentrated in what we would describe as leisure and hospitality. So you're thinking about hotels and restaurants and anything that might be travel related. At one point, the employment in that industry was about 50% off where it had been prior to the pandemic. Then you can see the most recent numbers. Things have certainly improved, but even in that industry, we're still about 10% less than we were prior. Mining is the other one worth calling out because some of the challenges in the energy sector had also been especially severe last year. The emergence of the Delta variant during the third quarter of this year did slow, I think, some of the optimism at a macro level. So the chart on the left-hand side shows that through the first half of 2021, consumer sentiment really was picking up at a significant pace. A lot of momentum in the economy and I think optimism around widespread vaccination. As the Delta variant started to become more prominent, you saw some of that back off a bit. And now there have been more concerns with not just the Delta variant or other persistence in the pandemic that might be happening globally, especially in Europe right now, but also other things that might be connected to inflation that I'll touch on later. We've seen also at the same time a shift in what's been contributing to GDP growth. And I mentioned at the outset that 2021 was expected to be pretty strong with some of the bounce back. But what's been driving the bounce back, it's worth pointing out that this is different than what we would have been seeing last year. Early on, it was really durables. And so when a lot of services were shut down, it was generally manufacturing and other goods-based industries that were driving growth to GDP. The beginning of 2021, that shifted though to services. And so you can see in comparing the blue bars and the red bars of this chart, that much more of the contribution to GDP growth was shifted to services. And again, that's not surprising if there was a belief that as widespread vaccinations became more common, that we would see service-based industries that had been shut down begin to reopen and that generating more impact to the economy. Again, that softened a little bit in the third quarter with the Delta variant, and you do see that by comparing the red bar with the green bar in the services category here. At the same time that you were continuing to see some weakness in durables just as a result of some of the shifting nature of the economy. Trade, both to and from the US, though, has strengthened, I would say, notably, despite what we've seen in changes in the value of the dollar. This has been especially important in agriculture, and so I do want to call this out because at the beginning of the pandemic, again, going back to March and April of 2020, there was a substantial concern that at the same time we were seeing a severe hit to ethanol production, for example, and meat packing plants closing down and commodity prices dropping. I'll get to some of that a little bit later. That we were all going to see persistent weakness in exports at the same time as this was a global phenomenon. When you look at the data, though, for exports, you can see that there was that sharp contraction, but it did bounce back pretty quickly. So if you look at the blue line, we're actually almost to the point where we were prior to the pandemic and maybe even a bit higher in terms of total exports. The same has been true for ag exports. We saw a bit of softening early on in the pandemic, but that did bounce back pretty quick, especially in the later half of 2020 with strong exports to China. I won't go into a lot of detail on that. I'm sure some other speakers have already referenced it. Some of that has softened a bit, but I would say in terms of the levels, it's still been higher than what might have been expected before the pandemic. The chart on the right-hand side is intended to illustrate a couple of things then. The first is the blue line in total imports. It's worth pointing out that despite all of the headlines that we may see about supply chain disruptions, the level of imports in the United States is as high as it's ever been. So the demand for products, the demand for goods and services in the United States has been exceptionally strong, and imports have been continuing to rise. This has occurred despite changes that we've had in the value of the dollar, and shown in black. Usually we see increases in the value as there is global crisis or uncertainty. And so you can see that pick up early on in the pandemic and then soften a bit. And now it's moved around here the last several months. Despite what fluctuations we have had there, though, imports have continued to rise. So generally speaking, the point of this slide is to say that trade activity overall, both exports and imports, has been quite strong. So we've heard a lot, though, about supply chain disruptions. And throughout this presentation, you're going to hear me coming back to three themes. Supply chain disruptions will be the first, then I'll talk about labor and then inflation before going into some of those things specific to agriculture. The chart on the left-hand side is a way to highlight some of the supply chain disruptions that I alluded to earlier. Specifically, if you look at new orders and backlogs of orders as it comes through from our manufacturing indices, both in the US or regionally, you can see here that this number is quite high. So anything above 50 indicates higher than a year ago. So when the index for backlogs on orders is at 65, this suggests that many manufacturers have new orders and backlogs that are going out months. And so some of the supply chain disruptions that have been ongoing are likely to persist because some of those backlogs are still persisting as well. At the same time, inventories are very, very low. So as long as demand remains strong and manufacturers are getting new orders and we're still moving things as quickly as they are, those inventories being depleted, we likely will continue to see some of those supply chain pressures persist. Many of you are familiar then with what's happened as it relates to transportation costs, and this is something that has, I think, fed through into agriculture and food products for that matter. Is the chart on the right-hand side. This is the price for a 40-foot container, and so we've all heard about the containers building up in the ports and the West Coast specifically, and the fact that this price index, is about 5 to 6 times higher than what it was prior to the pandemic. So obviously surged through the end of 2020. It looked as though things were stabilizing early in 21, but then continued to pick up. We have seen that pull back a little bit, but still at very high levels relative to where we had been. Okay, so supply chain disruptions is the first part of that theme. The second is labor, and then I'll not spend too much time on this slide before going to inflation. There are a number of different ways that I could try to describe the labor shortage, but one way of doing this is simply as a measure that I'm referring to as the availability of workers. And this is an admittedly oversimplistic picture of the labor shortages that we're facing in the United States by taking the number of unemployed people relative to the number of job openings. So anytime this measure is less than 1, which you see as the solid line here on this chart, that would indicate that there are actually fewer unemployed workers than what there are jobs available. Now, of course, we know that it's not necessarily true that only unemployed workers are going to be taking new jobs. You're going to get some changes in the labor force and you're going to get people moving around. But just as a broad way of looking at this, the point is to illustrate that early on in the pandemic, we saw a sharp increase in this number because of all of the layoffs that were happening. But as people began returning to work and businesses began to post new jobs, feeling as though conditions were exceptionally strong, we're continuing to hear now labor shortages that I would say are not only mirroring what we would have heard prior to the pandemic, but probably even more severe. We can't get too far into most discussions with businesses, ag or non-ag, where they're not highlighting the challenges of finding labor. So the third one that I want to touch on here from a macro perspective, and then after this slide, I'll start to shift a little bit more into items that are specific to agriculture, and that is with respect to inflation. The Fed has a target for inflation at 2%, and without going into all of the details, I'm glad to take questions on this. We have changed our framework in terms of the way that we describe inflation and what kind of future inflation might be allowed, so to speak, to capture some of the disinflation that we may have had in years prior. But the point of this chart really is just to illustrate that we've been seeing pretty dramatic increases in this number, as everybody's aware of. This has been for not just overall inflation, but even for food, for example. As you look at the category of food away from home, so how much people are spending on food outside of the house at restaurants, that percentage change from year over year is, I think, the highest that it's been since the early 1980s. So we're continuing to see price pressures here. This is affecting many producers through the supply chain. It's affecting those both downstream and upstream, obviously on a retail side, but also those that are dealing with input costs further along the supply chain. Okay, so I'm going to start to shift gears here now, and I wanted to kind of set this stage from a broad economic perspective before going into more specifics to agriculture, because though we've seen a pretty sharp bounce back in the US and global economy, there are a lot of risks out there, and we're expecting to see growth maybe soften a little bit as we go forward and some of the bounce back starts to wear off. The point that I want to illustrate in this chart is that agriculture has been in what I would call as a sort of surprising bright spot, especially when we consider where things had been in the years prior to the pandemic. Through the recession the last time and in the years that followed, ag was actually doing very, very well at a time when the rest of the economy was in crisis and then recovering quite slowly from 2010 to 2013. So what you see in the far left part of this chart is simply a recognition that the US economy, as measured by real GDP, was growing at a pretty limited pace, while net farm income as a broad measure of ag output and prospects was much, much stronger. We then shifted to the later years of the recovery in the broader US economy, and you can see that growth actually picked up, so momentum was building. It became, like I said, the longest economic expansion on record for the United States from 2015 to 2013 to 19. But that was about the time point when things started to turn in agriculture, the year 2013 or 2014, and farm income was actually quite a bit lower than it had been in years prior. Now, if we move forward to the most recent time period, you can again see that we're trying to get back to a point nationally where economic growth is similar to where it had been prior to the pandemic, or the level of, I should say, the level of economic activity to where it had been. But we're quite a bit higher now as it relates to agriculture at the level of output, or in this specific indicator measured as net farm income, relative to where we had been in 2019. So the picture that emerges from this slide is that even though the US economy is still trying to get back to where it had been prior to the pandemic, ag has already exceeded that number. Okay, so I'm going to shift gears here and go more specifically into what this means and ultimately end with implications from an ag finance perspective. Most of the information that I'm going to show is going to be at a pretty high level, so I'm not going to go into a lot of details on this because I just want to get to the point where we're talking about conditions in ag finance. Most of you are familiar, though, with the story, I think, of what's happened as it relates to ag commodity markets. And I'm showing just 3 time periods here across a number of different commodities to tell a couple of different stories. The first, and all of these prices are indexed back to the average of 2019 to give a sense of what this picture looked like prior to the pandemic. And then the middle part of the chart is in the worst parts of the pandemic. So again, April, May of 2020, and then prices that we're seeing here most recently. So again, prior to the pandemic, agriculture was in a place where it had been pretty weak for about 6 to 7 years. So keeping in mind that the starting point in agriculture was already a bit subdued. In the initial months of the pandemic, it was actually expected that things were going to get even worse. We had a 20% or so decline in the prices of many of our major commodities. At that time, in April of 2020, a lot of people were concerned that we might see a massive wave of bankruptcies in agriculture by the end of the year, that we would see rapid declines in farmland values, for example, and just generally a lot of severe pressure building on pressure that had already existed prior to the pandemic. We know now that that was not the case, and as you look at prices here most recently, many of our major commodities are substantially higher. It's worth pointing out that in the previous recession, from the end of 2007 to 2009, it took about 2 years after about the middle of that recession to get back to a point where these major commodity markets were beginning to get close to where they were earlier. That was admittedly from very high levels, but what you're looking at here is only 1 year from the beginning of the crisis. Corn prices, for example, were already 50% higher than what they were. So major increases in prices, again, much of that driven by strength in exports to China. Of course, there's lots of difference across different categories of commodities. The cattle industry has been weaker and slower to recover. It's worth highlighting that weakness because my general comments about the strength in agriculture are there's a caveat there that that's not true everywhere. It's obviously not true in cattle. Dairy has been a bit more challenged as well. Parts of the country that are especially affected by drought, it's worth pointing out some of those weaknesses as well. Okay, as I alluded to earlier, though, net farm income has definitely moved higher. We know that government payments have been a big part of this. I'm not going to go into the details of that. I'm sure others have addressed it. Reflecting back onto where things were from 2019, which again was a period of relative weakness in agriculture. Things were improving already in 2020. They were expected to be a bit better in 2020, even before the pandemic. So as you see in that second bar, much of that was driven by government payments. The most recent estimate has sort of reconfirmed that farm income is expected to be about $20 billion higher than where it had been on average from 2015 to 2019. Again, government payments a big part. And then the forecast for 2021 expected to be higher as well. There's been some changes to these numbers and revisions. I'm not going to spend time talking about that, but the point is simply to illustrate from this slide that relative to 2015 to 2019, farm income is expected to be about $40 billion higher in 2021 relative to that earlier period. So worth highlighting this again at a high level to reiterate the strength in agriculture relative to where we had been prior to the pandemic. So what this has also meant, though, is not just an increase in farm income that we've seen here most recently, but also estimates and forecasts for the future that have built in, I think, some sort of shift in income derived from commodity market or commodity production that resulted in a level shift higher of expectations for farm income going forward. There's a major caveat to this that we don't know exactly what's going to happen with input costs, and I'm going to come back to that in a minute. But what I'm showing on this slide, it comes from FAPRI that I'm sure most of you are familiar with at the University of Missouri, where they make long-term projections. USDA would do something similar, where the blue line here is showing the average projection that was made during those relatively weak years in agriculture. So from 2015 to 2019, you can see at that time, they would have generally expected farm income in 2021 to be about 80 billion. Now you can see as you move forward, though, if you look at the most recent projection in red, those projections have all moved higher. So you're looking at, on average, about $20 billion higher for farm income going forward than if you were to simply just extend that blue line outward for the next 5 years. So there's generally been an expectation that some of the increased profitability, the increased income is likely to persist. Again, there's many risks that we could go into here, but in ways that maybe were not expected prior to the pandemic. I talked a little bit about ag exports, and this chart is to illustrate the strength in exports and driving a lot of this maybe increased optimism that was not expected from 2015 to 2019. We've been talking about the pandemic as long as we have been. A lot of us might have forgotten that from 2018 to 2019, the major theme of everything in ag and the broader economy had to do with trade disruptions and not supply chain disruptions. So we recall back to those years as a time when there was a lot of concern about how trade might evolve. Of course, China being a big part of that. We're familiar then with the signing of the Phase 1 deal in early 2019, I believe it was, and what that was going to mean for trade prospects going forward. The chart that I'm showing on this slide is ag exports through September of each of the time frames that's shown here. It's worth pointing out on this slide that it was about the July timeframe last year that we started to see exports really begin to rise. So it wasn't until later in the year that some of this really started to have an effect. If you look at 2020 relative to that earlier time horizon, when we were seeing maybe some concern with trade, it hadn't been a lot different yet by that point. China then began buying a lot of corn, which was unusual. And just generally speaking, the bounce back in economic activity resulted in a significant increase in US export activity. And so you can see that playing out in the bar that's shown for 2021. So suffice to say that ag exports have contributed a significant amount to the overall strength in commodity markets. And this is fed through, I think, to some of the increased prospects and revisions higher to prospects for the future for farm income. I talked a little bit about costs, and it's worth spending just a couple minutes on this as well, because I think this is probably in the minds of most producers these days. I'm sure that everyone is having conversations about increases in fertilizer costs and other things. And I wanted to just show one chart to basically confirm or affirm some of those things that we're also hearing. We're hearing a lot of those anecdotes, but as a way to show some data that might be specific to it, again, building off of some of the previous information from FAPRI, I wanted to reference back again to that period from 2015 to 2019 and the costs that were expected in 2021 and then how costs are expected to evolve from 2022 to 2026. So the way to interpret this chart is that, for example, the dark blue bar represents the percent change in costs relative to what we experienced from 2015 to 2019. Again, 2015 to 2019 was a period of more weakness in agriculture. So as you move forward into a stronger period, it's expected that these costs are going to rise. The point that I really want to drive home though on this slide is not so much the level of any of these categories. It's the fact that the light blue bars are higher than the dark blue bars. What that means is that costs are generally expected to continue to rise. And there's a couple notable ones there. Labor is worth pointing out, for example. Some of the other costs related to seed or rent or even interest, for that example, as we're coming out of a period where monetary policy, and I'll go to that later, has been an exceptionally accommodative period of time. So most costs are expected to see continued pressure, and I would add that also fits with the anecdotal information that we're getting from producers and agribusinesses and others that are seeing costs rise, again, reflecting labor, reflecting supply chain disruption, and many other things that are connected to the broader economy that I alluded to earlier. Okay, so that's kind of a general picture for the broader farm economy, having described first the general economy, and now I want to talk about how this is affecting the picture for agricultural finance. Prior to the pandemic, we were seeing financial stress rise. We were seeing bankruptcy rates increase. I'm sure that Ohio was probably a state also because of its concentration in dairy, that there was some concern about multiple consecutive years in dairy. Most of the bankruptcies that we were seeing increase in terms of the increases in bankruptcies were showing up in Wisconsin, and many of those were in fact tied to small dairies. So there had been a rising pressure and financial stress. It had been relatively modest, but it was growing over an extended period of time. With all of the recovery that we've experienced in the broader economy and agriculture specifically, pretty much every measure that we look at now would actually show that financial stress has eased considerably. So a couple of high-level measures to show on this. The first is farm loan delinquency rates that you see on the left-hand side. And you can see, for example, that whether it's the farm credit system or commercial banks, both of those measures have reversed the trend of what we had been seeing prior to the pandemic, and delinquency rates have actually moved considerably lower. Very few lenders that we talk to would describe significant issues that they have in their portfolio now with delinquencies. Many banks are flush with cash. Again, a lot of this tied to some of the government support programs and stimulus as well. But many lenders would be in a position to continue to provide loans at a time when most producers are much more capable to repay those loans, and that's shown by the chart on the right. We do a survey at the Kansas City Fed of commercial banks with a concentration in agriculture, and there are a number of other regional reserve banks that do the same, that have a high footprint in agriculture, and that's shown in the right-hand side. So when we look at the Minneapolis Fed or the Chicago Fed, St. Louis, the point of this chart is simply to illustrate that across all of these regions, loan repayment rates have moved higher. They started to move higher at the end of 2020 as some payment checks started to roll in, but then also as commodity prices started to pick up. So different than previous years, working capital has been much stronger. The liquidity positions of borrowers has improved dramatically. They actually need less financing now than what they did before because they're self-financing again. During the really good years in agriculture from 2010 to 2013, most of what we heard from our lenders was actually that they were having a hard time finding demand for loans because borrowers were in a position to self-finance. We then went through a period from 2014 to 2020, as you see in the chart on the right-hand side, where financial stress was just high enough so that producers needed the loans, but repayment rates were just strong enough that they were generally repaying those loans. And, so banks at that time were seeing pretty strong returns. And we're back to a period now where demand has been softening and producers have been in a better financial position. So this is illustrated to some extent in terms of the demand for financing and just general environment of debt on this slide. And this shows call report data for the commercial banks across the country, and then also the same analogous data for the farm credit system. The point that I want to make on this slide is first, if you look at non-real estate loans, so those would be the dotted lines, the point that I just made about producers self-financing comes through in this picture. As you can see, about the middle of last year, the total dollar value of loans outstanding for non-real estate loans has been continuing to soften. And we're actually about 10% less at commercial banks for non-real estate loans relative to last year now, if you look at that last data point. Real estate loans have been stronger, and I'll touch on this in just a minute, but we're seeing markets for farmland being exceptionally strong, and as most producers would not be in a position to be able to self-finance as it relates to real estate, that's generally been higher. Most of you may already know that that Farm Credit provides more in the way of real estate lending than what commercial banks do. And so as we've seen the increases in real estate loans, much of this has been concentrated in the Farm Credit system. On this point of farmland markets now, I want to spend just a minute talking about some of these changes, because again, as I mentioned earlier, in the early months of the pandemic, it was expected perhaps that we were going to continue to see some declines in farmland prices, building on previous year's declines, especially in the Midwest, but maybe even getting worse because of some of the challenges with the crisis. That turned out to not be the case. And in fact, what we're seeing is exceptionally strong gains in farmland markets across much of the Midwest. This data is just simply showing from USDA data, which I will say is a bit dated. I'll describe some of ours, the data that we collect in just a second. But the chart on the right-hand side, or the map, I should say, is showing, for example, about a 15% year-over-year increase in land values in a state like Nebraska or Kansas versus a 13% decline from the time period of 2015 to 2020. I mentioned in the previous slide that we have data that we collect from commercial banks in our district. And part of that is asking them for information about farmland values. In our district, those land values as of the third quarter of 2021 were 15% higher than in 2020. But the Chicago Fed also does a similar survey, and their survey would show that a state like Iowa has about a 28% increase in land values relative to last year. So exceptionally strong gains, back to double digits that were not experienced in the years prior, in fact, declines, and compare with maybe where we had been during the good years in agriculture in the early 2010s. Okay, so I want to end with talking about interest rates and the Fed, because a lot of this discussion on the broader economy and things like inflationary pressure, and to some extent, even interest rates to the extent they're supportive of farmland values, is relevant for the conversation here. So most of you are probably aware of some of the accommodative policies that have been implemented by the Fed. Many of them have been somewhat unprecedented in the early parts of the pandemic. Low interest rates generally have been supportive of farmland and other interests in agriculture, and you can see this in the left-hand chart on this slide by just recognizing that rates are as low as they have been, both for operating loans and for real estate loans. So again, providing easier financial conditions for producers and generally backing some of the gains that we've seen in farmland markets. The chart on the right-hand side is just to quickly describe how Fed policy has evolved during the course of the pandemic. So as you would typically expect, when there is an economic crisis, the Fed steps in, and the first thing that they would do is reduce short-term interest rates to spur economic activity. That's sort of the standard approach to monetary policy, and we've seen that before. And so you can see the dark blue line having moved to zero, and short-term rates, which really do feed into the chart that you see on the left-hand side, have been kept roughly near zero since the beginning of the pandemic. At the same time then, because of the severity of the shock, the Fed returned to what previously was known as quantitative easing or large-scale asset purchases, and started buying new assets and expanding its balance sheet so as to drive down longer-term interest rates. So those do tend to feed into, for example, longer-term rates that might be useful for thinking about farmland markets. The Fed's balance sheet had been easing off a bit from the $4.5 trillion prior to the pandemic, but then quickly ramped up with new programs that were implemented early on. It was announced just a couple of weeks ago that these asset purchases would start to fade a bit, but we will continue to add to the balance sheet until roughly the middle of next year. And so you'll continue to see this having an effect in terms of stimulus and effect on long-term rates. Okay, so I want to wrap up here with a few concluding thoughts, and then I'm glad to take questions for however much time remains. I won't go through all of these lists of risks, but I just want to highlight that there are many. I would say that the near-term outlook for agriculture is still quite strong, but long-term risks could lead to more pressure. I really want to emphasize the input cost pressures on this slide specifically, because we've seen that not only increase the past 3 months, but increase at a faster pace. So there's a decent amount of concern about that. A lot of that has been tied to supply chain disruptions that we know about, and transportation being part of that. But any of the other items on this slide could also be other things to spend an entire day talking about as it relates to longer term risks and things that will still be relevant for the conversation. But I would highlight the input cost pressures and supply chain disruptions as two that are probably maybe most front and center at the moment. I'm going to stop there, but I'll be glad, Ian, to turn it back to you to facilitate discussion, or as you see fit.
Well, there we go. Thanks very much, Nate. That was you covered a lot of ground there, and I'm sure there are going to be some questions from the audience. And I already see one in the question box, which second one's just popped up. So let's start with, actually, they're both from the same person, Jackie Fatka, who's a journalist who many of us here at Ohio State have met and talked with. She's going back to a question she asked yesterday, but she's interested in your insight on the labor impact vis-a-vis agriculture, and with the amount of money from the infrastructure plan, who's going to build the bridges and ports that are important to the agricultural? I mean, one of the things we're learning, I guess, in the supply chain crisis is that we have transportation problems that predate the pandemic. The pandemic's just highlighted these issues with, shortage of capacity in Long Beach, problems in Savannah, et cetera, not enough railroads coming out of California, et cetera. So how do you think the infrastructure plan is going to affect, I guess, benefit agriculture in the long run?
Yeah, those are important questions, and the labor shortage question is again, I think, an exceptionally important topic, and it's going to be important, I think, for some time. What I would say to that is simply, again, to reiterate that a lot of our contacts, when they talk about the supply chain challenges that they're having, is that many of their suppliers are describing the problems with labor as really being the constraining factor of why they're not able to deliver a product. And then if you follow that through the supply chain, what that means is that if they can't produce a part and send it to, the next person in the next entity in the supply chain, that they then can't produce their parts and intermediate goods and other things. And so maybe they have to shut down their line because of supply chain disruptions, and they're having labor shortages of their own problems to be able to continue. And so to some extent, I think that the challenges that we're experiencing with supply chain disruptions and inflationary pressures very much are tied to what we're also experiencing with labor. And again, the reason I highlight that is because what happens with labor to a significant extent will, I think, determine some of those others. To the specific point of this question, we do know that some of the infrastructure in this country, and again, specifically looking at things like bridges, but also, looking at the lock and dam system that's been talked about for a long time as maybe necessary and needing improvements to compete on a global scale. We know that infrastructure in the long term will benefit agriculture and other industries that obviously rely on it. But I think that it is, and I'm really just kind of confirming the question here, worth asking about the shortages in labor and really how some of that unfolds, because I'm not sure that we're at a point right now where we have the labor that might be needed for a lot of different activity in the economy, and that might be another example of that.
Okay, so I'll come back to Jackie's second question, because it's kind of the billion-dollar inflation question. We'll save that one for a minute or two. But for my former colleague Alan Lyons, he asked, what underpins your optimistic near-term outlook for the ag sector?
The main thing there, and that's a relative, I guess I'll give a relatively simple and straightforward answer, has been the strength in commodity prices. We're seeing prices extremely high, and while we know that input costs also tend to rise as commodity prices are high, eventually those profit margins are squeezed. At least in the short term, it has meant a significant increase in cash receipts and revenue. Again, specifically for corn and soybeans and other commodities, crops specifically. Less true for livestock and other industries that maybe drought has had an impact and high feed costs have had an impact. But in aggregate, I would say the optimism is coming from increased revenue for 2021, building off of substantial government payments that had existed prior. And all of that increased profitability and revenue has been a way to pay down debt and put producers in a better financial positions than what they had been prior. The second thing I would say is, again, an additional comment on land values. If there's one indicator that you want to look to as an overall measure of financial health and agriculture, land values might be one place to look. And we're starting to see record values of land again. And so, the optimistic near-term view for agriculture is really just a recognition of how things have transpired over the course of the past year. Again, I don't know whether that's sustainable. There could be more pressure, but for the time being, at least this year and next year, it's appearing to be quite strong.
Okay, so I'm going to go back to Jackie's question, and I'm going to throw a little bit of my own question in there as well. This is obviously a big issue that is affecting the way the voting public are thinking about the way the economy is right now. This is about inflation, of course. So Jackie Fatka again, she asks, are we headed towards stagflation or a big inflation crackdown, 70s style that led to, I guess, eventually 18% interest rates in the 1980s? And I would pin onto that. Paul Krugman had a column maybe last week where he said we shouldn't be comparing now with the period of stagflation. We should go back and look at the period just after the Second World War, where the US economy was growing quite fast and there was inflation, and the monetary authorities came in and tamped down and actually led to a recession. And he's arguing that's the more relevant benchmark, not the 70s and the 80s. So I guess I'm combining my question with Jackie's question. So if you can start with Jackie, and then you can tell me if you think Paul Krugman is right or wrong, if you want to argue with a Nobel Prize winning economist.
Well, that's dangerous territory there, as I'm sure
that's
you know.
what I said.
What I would start with in answering this question is to recognize where we were prior to the pandemic. Again, the Fed has had a goal for inflation at 2%. Many major economies also have targets for inflation. Prior to the pandemic, inflation had been running persistently less than 2%. So that's important context, because it suggests that whatever trends had been in place prior to the pandemic, they were disinflationary trends. In other words, we were having a hard time at the Fed and other major economies to actually get inflation above the 2% target. As you move into the pandemic era, again, reflecting all of the things that I've talked about on supply chain disruptions, labor shortages, and other things, it's obviously generated a significant increase in inflationary pressure, stimulus payments as a part of that, and substantial payments at that, not just in the US, but globally. So there are a number of factors that have boosted inflation, have increased some inflationary expectations, but many of those are maybe also viewed to be transient, in the sense that they will start to fade over time. To a certain extent, some of the things that we're dealing with now are probably still tied to the reopening in the economy. And so I think that there's a case to be made that inflation could start to weaken a bit going forward as things normalize. Now, the longer that we're in this environment, though, where prices continue to rise, that sort of pushes back against that narrative. And the longer that we see supply chain disruptions and labor shortages persist, then it would provide evidence to the counter. From the Fed's perspective, last year we did communicate with the public that we were going to change the way that we think about inflation, and we were going to allow some higher inflation to compensate for some of that lower inflation that we experienced earlier before the pandemic. That's not to suggest that inflation would, if inflation really did persist and continue to increase, then part of the Fed's mandate as price stability is to adjust monetary policy so as to bring inflation back in check. So as a long answer to that question, what I would say is that if we continue to see inflationary pressures rise, and more importantly, if we see inflation expectations continue to rise, then the Fed would need to step in and address that with policy that would ultimately be less accommodative to bring inflation back towards the target. But again, I think that where we're at right now is sort of waiting to see how things evolve, to see how permanent versus transient. That's been a big part of the question.
Thanks. I mean, I think that's pretty much what most macroeconomists are saying now. I mean, there are some inflationistas out there, as they get referred to, but I think you're probably right. That seems to make a lot of sense to me. We have a question from Aria McLaughlin. What impacts do you see in agriculture from the subsidies in the COVID federal relief bills? And what might we expect to see from the injection of funds from the infrastructure and Build Back Better bills? I think that's sort of building on Jackie's earlier question about infrastructure spending. Thanks for the question, Aria.
Yeah, so there's a couple things that I would say there. First is that in the time of crisis, when you do inject government spending, it will offset some of the weakness that we see in the economy that would have played out because of the crisis. Difficult to know, for example, what would the crisis have looked like had there not been some of that stimulus and some of those payments. I think one of the risks that we face, not just in agriculture, but potentially even the broader economy, is that it's possible that some of those supports, whatever form they may take, provide a substantial amount of accommodation, but they ultimately are an incentive structure that then causes producers, businesses, households to adapt. And there's a possibility then that later on, you may see some fading effects from those. So for example, in agriculture, if there are some programs that largely incentivize increased production, or at least not pulling back on production, and we revert to the trends that we had prior to the pandemic, you could easily see an environment then where production has stayed very, very high, but the longer term growth prospects, if they do fade, would bring us back to a period where we actually are weaker than where we were. So I think that they're important to recognize for the short-term influx of cash and support. And again, at a time that we were in last year with the crisis, not disputing the need for those, but simply recognizing that as those effects wear off, we ultimately will revert back to supply and demand and what that means for prices. So longer term, I think there probably are still some risks and questions in ag once some of these programs wear off. And ultimately, we think about what the long-term price environment might be. Input costs, if they stay where they're at, we might not be talking about $4 break-even costs on corn. We might be talking about $5 break-even costs on corn, for example. And so, even though prices are high, it's quite relative if input costs have largely adapted to that environment.
Okay, so Nate, I'm going to go take us back to the GDP numbers. Some of these forecasts for, well, what's happened in 2021 and even some of the forecasts going out to 2022, we had a big shock to the economy, or economies around the world in 2020. And some of this is, some of the inflation discussion is about what base are you using to measure inflation. So if we were to do some adjustment to these numbers, I know the British numbers, for example, came back very quickly, but Brexit is being forecast to take 4% of British GDP growth. So beyond Brexit, which I don't necessarily expect you to comment on, but what do you think could push us off path for these returns to these, sort of normal growth rates that you might expect post-pandemic?
Yeah, I think the major concern would just be whether or not the strength that we see in our economy is fundamentally associated with demand, or if it really is more of a supply constraint type of question. If the strength that we're seeing really is being driven by substantial demand increases, then that will continue to have broad effects that of course will have implications for things like inflation. If it has to do really more with just supply chain issues and other things that might be a bit more temporary, then that's a bit of a different picture. At the same time, and maybe this is to your question also, depending, much of this is going to be contingent on what happens with inflation. If inflation really does start to increase and eat away at any kind of real economic growth and despite the increases that we're seeing in broader economic activity, then that will create some additional challenges. And to the earlier point, if inflation expectations continue to rise, that's maybe even a more challenging environment when you think about how businesses make decisions for the long term. So I would say that a lot of the concern, rightfully so, is focused on what may or may not happen with inflation. And you're right, I can't comment on Brexit necessarily, but some of the numbers in other parts of the world which would be showing similar concerns with respect to inflationary pressures.
So I had another question about the trade side, which I sort of found interesting. I haven't looked at the trade, what the current account numbers look like right now, but it seems like there's two interesting things happening. Savings rates have probably gone up, right? At least across some parts of the economy. So you'd have expected that maybe to put a dent in the current account deficit, given that low savings rates tend to be, in the US case, associated with the long-running trade deficit that we've been had since the 1980s. Yet people are living at home, spending money on all these durables. How do you think that's going to shake out in the end, the sort of trade-off between increased consumption, because we're all sitting around in our offices at home, but higher savings rates? Do you think that's all going to wash out in the end, and the trade deficit's going to carry on at about $800 billion a year or whatever?
Yeah, I'm not sure about the specific connection to the level of the trade deficit, but I think that it's probably at least realistic to think that as the economy returns to something that might be more normal, and more of the service-oriented industries start to emerge, and you see more travel, for example, that you would at least see less spending in the way of goods, and some of those things that I think have contributed to the things that you've just described. So I'm not sure exactly what it might mean as it relates to the trade deficit, but you're right. And again, kind of commenting on an earlier slide, the level of import activity has been exceptionally strong. We all know about the chip shortages and those things, as other tech firms have tried to also expand and thinking about global supply chains. I guess one thing I would add to that, just maybe to insert into the discussion, is, and this is probably a significant source of uncertainty, is to ask the question of how supply chains themselves might evolve in the future on the basis of what we just experienced. You hear a lot about the idea of onshoring businesses because they want to be closer to their supply chains and be able to manage them easier. We used to live in a just-in-time world of delivery, but now a lot of businesses are saying that's not going to work anymore. We need something that's more reliable. And so as some of that trade maybe shuffles a bit, it's going to take a while, I think, to see how that plays out, to get a sense of what that means for maybe more of the macroeconomic impact. And I think that we're probably just way too early to be able to say something about that until we start to see something more normal with respect to supply chains.
Yeah, it's interesting. I raised this issue yesterday at the end of my own presentation, and I follow the writings of Paul Antras, who's a trade economist at Harvard, and he was writing early in the pandemic, and he was suggesting, after the financial crisis, we saw very little reshoring. We saw a slowdown in the growth of global supply chains, but we didn't see much reshoring. And his argument was the sunk costs of having gone offshore. You've then got to reinvest in new supply chains, and so there's and I think firms are still going to be holding off for some time, as you suggest, because he was arguing we don't know enough yet about the pandemic and how it's going to impact on those global supply chains in the long run. But it's certainly given journalists a lot to write about, that's for sure. So I have one closing question for you. You mentioned the tapering of, I guess we'll call it quantitative easing. So we know in the financial crisis that a lot of developing countries got pretty upset with the United States as, expansive quantitative easing, and how that affected their own financial flows and the way they were able to adapt to the recessions that they were facing. And I'm particularly thinking about countries in Latin America, Brazil, and Argentina. We're going the other way this time. We're tapering at a time that we're coming out of the pandemic. Do you see any of those global spillovers of what the Fed is doing to the global economy, potentially negative impacts?
Yeah, that's a good question, and it's maybe even to the earlier discussion about inflation and the pace at which the Fed may need to consider tightening, because we know that what the Fed does, what the US does relative to other central banks will have an impact on exchange rates and thinking about current accounts or other things there as well. And so, we did see pressure that you alluded to in emerging markets specifically. And, so far, I would say that there have been some places where there's been some concerns. There have been some concerns that have popped up most recently, for example, with Turkey. So I think that it's worth pointing those out as some places to be watching and monitoring, especially as it relates to some of the countries that you mentioned, because they do have large agricultural concentrations as well. And so when you think about competition on a global scale for exports, obviously it matters a lot what happens with the Brazilian real. And when you think about China and the strength of its exports or imports into China, that, depending on what happens with exchange rates, can either fuel or put the brakes on demand for US ag products if they can be sourced elsewhere, Brazil and Argentina being a couple of examples. So I think that it is important to monitor that. I think that for right now, it's also important to recognize that even though we've announced some reduction in those asset purchases, we are still adding to the balance sheet. And even as those purchases start to fade, the balance sheet will still be very, very high for quite some time. So even though there may be some changes there, again, just recognizing that we're still at a very different level than what we would have been prior to the pandemic.
Okay, I think we've probably exhausted the question. I have many more questions, but I don't want to dominate the discussion. So if there are no more questions from the audience, I'd really like to thank Nate very, very much for an excellent presentation. And it's always interesting to hear the ag sector sort of put in a broader perspective. And we really appreciate everything that you were able to tell us this morning. And, I know folks from the Fed always a little tricky situation about forecasting where Federal Reserve policy goes. I have a friend who works at the Cleveland Fed, and I'm always on an Outlook conference with him at Ohio Wesleyan University. And however hard I try, I can never get him to say anything that moves away from the position that the Fed takes. So you gave us a lot of information there, and we thank you very much for that. And I'd like to thank everybody who attended today's session. Nate's slides will be available for anybody who would like to take another look at them. And his presentation recording will also be available after this session. So without further ado, I'm going to sign off for this particular session and then just remind the audience that we're going to be back just under an hour for our final session of our program, which is a discussion with Jonathan Koppes about where he thinks the next Farm Bill negotiations might go. So we're going to have kind of a virtual armchair discussion with me asking questions and Jonathan engaging with me and hopefully the audience that's online. So thanks again very much for everybody for attending and for Nate.